Stanley Black & Decker is a dividend king. A dividend king is considered one of the highest quality types of dividend growth stocks the investor can invest in. These are companies that have increased their dividend for at least 50 consecutive years. In the case of Stanley Black & Decker, they now have a dividend streak spanning over 54 years. In other words, for 54 consecutive years, the company has increased its dividend. It's an A-rated stock, and as you can see, the stock price has tracked earnings very consistently year after year, and it becomes obvious when the stock is overvalued, obvious when it's fairly valued, and even more obvious when it's undervalued, as it currently is. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, proudly bringing you part 3 of my 3-part series on the gifts that this recent bear market has given us. You know, one of the things about the bear market started a couple of months ago, maybe a month ago. I'm not sure the exact date, but we've officially entered a bear market as of about a week or two ago. And prior to that, we've had this bull market that's been running since 2009, since the end of the Great Recession. And it has really, that coupled with low interest rates, has driven stocks to not just all-time highs, but all-time valuations. And there is a difference, and I think that's very important. So stocks are trading at higher PE multiples, lower earnings yields, lower dividend yields than they historically have, especially the dividend growth stocks. Because interest rates got so low, dividend growth stocks became very competitive with debt investments like bonds and CDs and things. And consequently, investors poured money into the dividend growth stocks, and many of them became overvalued. Now, the problem is there are something like 44 dividend kings. And I covered a lot of them, went through a lot of them throughout this, 3-part series, which this is the final part. But there are only 12 that I consider currently buyable. There are bunches of them that have become cheaper as a result of this bear market, but have not quite gotten into what I would call fair value, offering fair value and a margin of safety and good future long-term rates of return, as well as, predictable, consistent dividend growth. Today, I'm going to offer you 12 of the creme de la creme of dividend growth stocks, 12 dividend kings that I think you could safely invest in now, especially if you're a long-term investor. And that's such a key to this strategy. The idea of being a dividend growth investor implies being a long-term holder, owning the stock for quarter after quarter, year after year, and seeing your dividend continuously increase year after year, so that every year you get a raise in pay, and regardless of whether the market goes up or down, you're getting an increase in your income every year. And consequently, when you do hit bear markets, which tend to be, as I pointed out in part 1 of this video, much shorter lived than bull markets, you can ride the bear market out because you're continuously getting more income. Dividends are paid on the number of shares you have, not the price per share. And that's very important to remember. So I'm going to go ahead and go through this here and go through what I consider to be 12 dividend kings that are currently trading at very attractive valuations. The first one I'm going to cover here is ABM Industries, and this is an environmental and facility services contractor. This company, ABM, has increased their dividend for 55 consecutive years. That's obviously a very admirable streak. You can see that down here by looking at the white line, which connotates dividends on your fast graph. You can see the dividend has increased every single year during this period of time. Now, you can go into the performance chart and you can discover that over the last 20 years or so, the dividend's grown by about 4%. This is not the fastest growing stock in the group that I'm going to give you here, but we did have a nice surge in growth during COVID. And right now, analysts are looking for modest growth of about 4% over the next 2 or 3 years. Their long-term growth expectations are a little more optimistic at about 10%. And the historical compound average growth over the last 5 years has been very high, but that can be misleading because it's contaminated by COVID. If I check this over all the years, you would see that their dividend growth is normally somewhere in the 7 to 8 to maybe 9% range. And that would be something more predictable. Now, given that, that means you can easily earn double-digit rates of return. The dividend yield is 1.78%. So if you're looking to invest in this company, I would suggest you want to look into this company as a total return investment with a dividend kicker that's growing each and every year. So that's your ABM Industries, the first one I'm covering. It is trading at a very low valuation. That's the key. This wasn't that overvalued during this market because of the surge in earnings, but you can see what happened when it got overvalued in the past. But anyway, that's ABM Industries. The next one is Dover. Dover is an industrial machinery company. It's a what I call quasi-cyclical, but really I would have to classify this almost as a double-digit growth stock. Earnings growth has averaged over 12%. Now, you can see that when stock was overvalued, how the price came down. But once again, it tracks earnings very clearly, and it becomes very obvious that when the stock is trading at high valuations, that's not the time to buy it. That's what we had coming into the first of this year. It has now fallen to a PE ratio that's within that 6.5% to 7% earnings yield. I'd actually like to see this one just a tad cheaper, but it's really buyable today given the quality of this company and the fact that it's increased its dividends so consistently. Dover has increased its dividend for 66 consecutive years. How predictable can you get? In other words, if you've owned this company for the last 10, 20, 30, 40, 50, 60 years or more, every year you got a raise in pay. Every year you got more dividend income the current year than you did the previous year. And you can now buy this stock. You can see how the price has become reasonable. Very rarely does this company really come with a true margin of safety. Now, normally the market prices this at around 19 times earnings. So if you're using the normal PE ratio as your, kind of your guide, then what you would find here is the stock does even offer you a margin of safety and very high rates of return. From a more conservative point of view, at fair value, you still get a nice 8.5% to 9% rate of return with a dividend kicker every year. Again, a 1.6% dividend yield that's increasing every year. Now, let me put that into perspective for you. That's about what it was yielding in 2003 here if you would have bought it, or 2004. And look how that dividend yield has increased. So some 17, 18 years later, the stock is averaging you a 7.7% dividend yield on the cost that you invested. Because remember, what's important here is the number of shares that you bought. And, the number of your shares has stayed consistent throughout each of those years. And so your dividend has been paid on the number of shares that you're getting. And that's critically important. So Dover would be the second choice that you have here. And again, it's a BBB plus rated company, a dividend king, over 50 years of dividends. H.B. Fuller is one that I just recently added to this. H.B. Fuller has increased their dividends for 53 consecutive years. Again, it's another semi-cyclical, about 8.7% long-term growth rate. It's forecast to continue growing at about 15% a year, so that gives you a little kicker. That gives you a nice total rate of return expectation of 13.5% for the next couple of years. If you use the normal multiple, which has been almost 19 times earnings, about a 24% rate of return. Again, a dividend yield about 1.2%. These are dividend kings. These are dividends that can turbocharge your portfolio. These aren't the highest yielding dividend paying stocks you'll ever find, but they're the most predictable and the most consistent. They are the kings of all dividend growth stocks, and you should think of them that way. This stock has entered fair value territory and, again, looks attractive to me. I think you could start taking a position. Again, if it's not below the orange line, I'd be more cautious with this than I would with the ones that give me a true margin of safety. Leggett Platt. Leggett Platt is another dividend king. Leggett has increased its dividend for 51 consecutive years, so it's a relatively new dividend king, but it is a dividend king. Again, you can always go to the performance chart. It's increased its dividend on average by about 6.5% or 7%. You can see the yield on cost has continued to grow, or what I like to call the growth yield. The beauty of investing in Leggett Platt today, you can buy it with a decent margin of safety. It's about 10% below what fair value would indicate, giving you the opportunity to make double-digit rates of return with a growing dividend. So I really like Leggett Platt here. The next company I want to look at is Lowe's. Lowe's is a 15% grower. You can see how the stock price has tracked earnings year after year. Lowe's has also increased its dividend for 60 consecutive years. In other words, for 60 years, this company's raised its dividends. Never been a very high-yielding company. Because of today's current low valuation, it's currently available with a 2.22% dividend yield. Consistent growth, consistent track record, consistent performance on this company. It's outperformed the market. It's outperformed it in income. It's outperformed it in capital appreciation. This is really a terrific stock. The housing market is beginning to slow down a little, could possibly have an impact on the future growth of this company, but this company still is expected to grow at double-digit rates going forward. If you use the normal multiple of about 20 times earnings, it offers a great margin of safety. But even at its more conservative estimate, it's trading at, fair value here. So again, I think Lowe's is fully buyable today. If history's any guide, this is one of the few times you can buy it when it's at or below the fair value estimate of about a PE ratio of 15. So Lowe's looks very attractive to me here today. 3M is another one of these, really terrific dividend growth stocks. 3M has increased its dividend consistently for 64 consecutive years. Think about that, 64 years. How predictable can you possibly get? Now, the growth rate varies on this company. You can see there are times when it grows it by double digits or high single digits, other times where it increases it by low single digits, as it's been doing here in recent years. That's because the company is moderately cyclical, been about a 7 or 8% grower. The market likes to put a premium valuation on this stock, except for those few short years during and coming out of the Great Recession. It is now offered at a very excellent margin of safety. I think 3M looks very attractive here. It's an A+ rated company. Dividend yield is 4.51%. That's the highest of any of the ones that I've shown you so far. It really gives you, I think, a tremendous opportunity of a lifetime possibly to invest in a quality dividend stock like 3M, get a way above average market yield, and also end up getting a decent rate of return on the same base. You can still get 15 to 20% rates of return, even at conservative valuations. If you look at its normal multiple, that rate of return could be much higher. 3M has had some issues now. You don't find good stocks at value without an issue. The question is, can they survive the issue? And my argument would be that they can. But again, nothing surpasses comprehensive due diligence and research. Philip Morris, or Altria as it's actually called, is another one of these dividend growth stocks that has been, really tremendous over the years. The company has increased its dividend for 52 consecutive years. The company keeps reinventing itself. It obviously sells tobacco. There's all the talk, that's ever since I've been in the market almost the last 20 or 30 years. This company just continues to give you, good performance. Now, the advantage of investing in it, you get a dividend yield of over 8%. Pessimists are always forecasting they're going to cut their dividend. They've not cut their dividend in all these years. So, the odds are, relatively slim. If I went through some other metrics here, which I always like to do, again, I'm giving you the quick version of these. If I look at operating cash flow, their cash flow did falter a little bit just before COVID, but generally speaking, their cash flows cover their dividend. It's BBB rated. I think it offers for an 8% dividend yield. If they ended up cutting their dividend or changing, I do believe that's already priced in. So I think your downside risk is relatively mitigated here. And you can always, change horses if things happen. But for now, take advantage of the 8.38% dividend yield if you're a long-term dividend growth investor. So Altria, or MO as its stock symbol says, is probably a great look. Now, natural fuel and gas is interesting. This was different from valuation. This is because growth has ratcheted up significantly. And if I look at forecast growth going forward, it's expected to grow at double-digit rates. It's obviously a gas utility company, and we all know what's happening to the price of gas and fuel and fossil fuels in general. So the company is expected to have double-digit long-term growth. As a result, you can buy it at a very attractive PE ratio with a dividend yield of 2.85% and a reasonable margin of safety. So National Fuel and Gas is also on the list of Dividend Kings that have increased their dividend by 52 consecutive years. A very excellent long-term streak. Again, their dividend growth has not been that high. around 3% a year, but that's typical for utilities. And utilities haven't grown as fast as it's currently growing. So that's something else to take into consideration. Remember, do your homework. Parker Hannifin is an industrial machinery company. Once more, it's a dividend king that's increased their dividend for 66 consecutive years. You can see how the stock price has tracked earnings growth. The stock is now available at a reasonable price, and I'm going to kind of move quicker through this so this doesn't get too long, the video, but you can see it was way overvalued last year. It's become reasonably valued now. Always go to your forecasting because that's where you want to make your decisions. It does give you a modicum, margin of safety at its normal value, premium valuation that the market likes to apply to high quality stocks like this. It's normally a 17 times earnings company. You can buy it at 14 times earnings. Dividend yield is over 2%, just slightly. Very attractive. Parker Hannifin is attractive. It's been buyable a couple of times in the recent past. The bear market has given us a great opportunity to invest in it today. Stepan Co. It's a specialized chemical company. It's increased its dividend for 54 consecutive years. You can see the market has been putting a premium valuation for the last several years. It's now trading at what I would call an attractive PE. It's not exceptionally undervalued. Maybe you could call it fully valued, modest dividend, but it's a company that if you're looking at going forward, it's expected to grow at 9.5% or 10%. Long-term growth is not available currently, but at its normal multiple, it does offer you a margin of safety. So this is one that you could look at. I like most of the other ones I've showed you more than this one, but this is obviously an option that you can look at thanks to this bear market. Stanley Black & Decker, you can see how we featured this in the beginning, how consistently it was, how obvious it was when it's overvalued, and how obvious it is when it's undervalued, which it clearly is now. It's going to have a slight down year in earnings. That's nothing new. That's happened to it several times. Stanley Black & Decker has increased its dividend for 54 consecutive years in a row. That's, obviously admirable. The dividend growth of this company now, as subscribers to Fast Graph, I'm highlighting things here. It's grown the dividend by around 6% a year, historically, at least for the last 20 years. So you can always check on that. You get almost a 3% dividend yield, 2.8%. Tremendous margin of safety. Looking at the future, your rates of return with a very modest or average growth of 7% could give you 26% annualized rate of returns. I often skate over this concept right here, but one of the things I like to do as an investor is run the numbers out to their logical conclusion. So if this stock just grows earnings as expected, and by the way, the analyst scorecard on this company is very good. They've only missed estimates about 15% of the time for a 1 or a 2 year forecast. Otherwise, we'll call it 85% of the time the analysts have been on the money. In fact, in that regard, from a standpoint of beating analyst estimates, they've beat it, about 15% of the time as well. So you're looking at a very predictable, forecastable company, offers a great margin of safety, almost a 3% dividend yield, and good dividend growth. So Stanley Black & Decker is one that's also very attractive. Now, the final stock that I'm going to show you here is still technically on many people's Dividend Kings list, and that would be AbbVie, which was a spinoff from Abbott. Even though I went in alphabetical order here, I left it for last because it really doesn't have a long-term dividend streak because it was a spinoff. And so I don't know how some people were still considering it a dividend king, but it has increased its dividend for 10 consecutive years since it's been spun off. So, you still might want to give it some credit. I did show it because it's inexpensive. It's got a 3.77% dividend yield. Humira is coming off patent. It is expected to have a down year, but I know some news today about some collaborations they've done. The company is expected, to continue to grow earnings going forward, but it's a little bit iffy till the Humira, but at least I did want to bring it out there and show it to you because some people still consider this one of the Dividend Kings, although, as I mentioned, it was a Dividend King when it was part of the Abbott Labs, whole company. Anyway, this has been Chuck Carnevale saying thanks for watching. This is the final part 3 of the gifts of the bear market. I focused on Dividend Kings here, some of the highest quality dividend growth stocks you can invest in. A very strong part of the theme of this video was the great Ben Graham quote where he pointed out that one of the most pervasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more, and remember, every one of these companies have done it for 50 years or more, is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in even limiting their purchases to those meeting this test. So if you're looking for high quality, you're concerned about the bear market, you're concerned about safety and risk, looking at Dividend Kings that are currently fairly valued might just be the ticket. And if you're looking for an increasing, dividend income, and as I pointed out throughout this video, for, many stocks that have really good upside opportunity, you might want to take a look at some of these Dividend Kings. This has been Chuck Carnevale saying thanks for watching. If you enjoyed this series, give me this video, give me a like, ring the bell, subscribe to the channel if you haven't already, and take a look at Fast Graphs. There's so much that you can learn about the history of the businesses you're investing in by being a subscriber to Fast Graphs. I wouldn't consider investing without the benefit that this tool has given me. It's the Fundamentals Analyzer software tool. Thanks for watching. Talk to you again real soon.